Welcome back to Gold Rush Reporter, where we cut through noise and focus on the real mechanics behind gold and silver markets. Today's discussion starts with a simple observation. Silver has been breaking records, and not by a small margin. When a metal moves with this kind of speed, it forces analysts to ask one question. Is this momentum driven by fundamentals, or is the market exposing deeper structural weaknesses? The hook is obvious. Silver pushed towards $61, smashed past $60 for the first time in history, and outperformed gold by a huge margin. That kind of move doesn't happen because traders suddenly got optimistic. It happens because supply tightens, liquidity disappears, and sentiment flips in a market where the physical base is thin. You heard the narrative? Deficits, supply chain issues, Chinese inventories at decade lows, COMEX disruptions, and a market already primed for a rate cut story. None of these factors individually explain a 4 to 5% surge. Together, they create a pressure environment where even modest buying triggers outsized moves. Silver is a metal with a dual identity, monetary and industrial. That combination makes it more sensitive than gold. When the monetary bid strengthens, silver responds aggressively because the physical supply cannot expand quickly. When industrial supply tightens at the same time, the market becomes structurally fragile. This fragility shows up in price action. Volatility accelerates, liquidity disappears, and the market moves in sharp bursts rather than smooth trends. That is exactly what we saw in this session. A fast rally, thin volume, erratic patterns, and a market reacting more to physical constraints than macro headlines. The engagement point for viewers is simple. If silver can move this violently on a day where the macro story is already priced in, then the metal is no longer just reacting to news. It is reacting to supply mechanics. And that is the part most retail investors miss. In this episode, we strip away the hype and focus on the structure. Supply, liquidity, rate expectations, and market microstructure. Silver is not rising because people suddenly like it. Silver is rising because the market is running out of room to absorb demand. This sets the stage for the deeper analysis in the next parts, where we break down the forces behind the rally and what they mean for the cycle ahead. Silver's surge is not just a headline event. It is a symptom of a market where several structural pressures converge at once. When prices jump this violently, analysts should immediately look past the narrative and focus on the mechanics driving the move. In this case, the mechanics are a combination of tightening supply, fragile liquidity, and a market that has been primed for a rate cut story. Start with supply. Global silver inventories have been drifting lower for years, but the most recent drawdowns are the most severe in more than a decade. When inventories sit at multi-year lows, the market loses its buffer. Any increase in demand, even modest, hits a thin physical layer, and prices react sharply. Silver does not have the luxury of deep, elastic supply like many commodities. Mining output grows slowly, and stockpiles cannot be replenished quickly. Then there is liquidity. Silver trades across multiple venues, but the London OTC market remains one of the most important hubs. When liquidity disappears, as it did during the COMEX outage and the thin holiday sessions, the market becomes hypersensitive. Prices move not because fundamentals change dramatically, but because there are fewer participants willing or able to absorb orders. Thin markets amplify volatility. This is why the rally appeared explosive, even though the macro story was already known. Rate expectations add another layer. Markets had already priced an 87% probability of a rate cut. That means the macro catalyst was not new. When a move occurs despite the catalyst being priced in, it signals that microstructure, not macro, is the dominant force. Silver rallied because the market had no room to absorb buying pressure, not because traders suddenly rewrote their economic models. Gold participated, but in a muted way. That divergence tells you something important. The silver move was not simply a risk-off or safe haven trade. It was a supply-driven spike. Gold remains more stable because its physical market is larger and more resilient. Silver, by contrast, is structurally tighter and more volatile, which is why it leads during supply stress. This combination, tight supply, thin liquidity, and a market already leaning bullish, creates a perfect environment for sharp upside moves. Analysts should interpret such moves as warnings rather than confirmations. A market that moves violently on already priced information is a market under stress. Silver's recent momentum cannot be understood simply by pointing at a single catalyst. The market is reacting to a combination of structural tightness and behavioral biases that amplify every move. When conditions tighten across multiple fronts at once, prices do not drift. They jump. And silver, because of its smaller physical footprint compared to gold, exaggerates these jumps. The most important element here is the supply side. Inventories in major hubs, especially China, have been hovering near decade lows. That is not a cosmetic detail. It means the market has lost its shock absorbers. In normal environments, excess metal sits in warehouse systems and dampens price swings. In the current environment, that cushion is missing. So when buying pressure appears, even if it isn't huge, the market has no slack. Prices respond in a way that looks dramatic, but is simply the mechanical outcome of scarcity. The second component is market microstructure. Silver's liquidity is famously uneven. Events like the COMEX outage demonstrated how fragile the trading framework can become. When liquidity thins, volatility spikes because the order book cannot absorb flow. This is why the rally felt explosive. It wasn't because fundamentals suddenly changed, but because the market structure was unable to absorb demand smoothly. Then there is the rate cut narrative. Traders had already priced an 87% probability of a cut. That means the macro story was not new. Yet prices still moved sharply. That tells you the move was not macro-driven. Instead, it was driven by physical tightness combined with thin liquidity. In other words, the rally came from the plumbing, not the story. Behavior plays a role too. When prices break a psychological level like $60, momentum traders join, headlines multiply, and participation increases. That inflow adds fuel, even if the fundamental backdrop has not changed dramatically. Silver's beta nature ensures it magnifies moves more than gold, which is why it outperforms during stress periods. Gold, by contrast, remained calm. That divergence is a signal. If the move were purely risk-off or macro-driven, both metals would move together. The fact that silver surged while gold lagged confirms a supply-driven event rather than a macro shift. Silver's spike isn't a clean, linear move. It's a pressure release. Anyone treating the rally as pure momentum is fooling themselves. When an asset jumps 4 to 5% in a single session, it rarely means everything is perfect. It usually means a combination of tight supply, thin liquidity, and a narrative trigger collided at the same time. That combination is fragile. Let's start with liquidity. The COMEX outage and the continued thin trading in London created an environment where even moderate buying pressure translated into outsized price moves. That is not a healthy market structure. It is a brittle one. Prices explode higher because there isn't enough depth to absorb orders, and they collapse just as fast when the flow reverses. Anyone who has watched silver for more than one cycle knows this pattern. Silver doesn't grind, silver whipsaws. Next, look at the supply side. Yes, inventories in China are at decade lows, and yes, the October London squeeze tightened the entire chain. But supply tightness does not guarantee a sustained rally. It guarantees volatility. Tight supply simply removes the cushion, which means price moves become more violent in both directions. You get the upside bursts, but you also get the sharp retracements, because there is no buffer to stabilize the market. Then there is the rate cut narrative. Markets priced the Fed move at nearly 87% probability. That means the bullish catalyst is already baked in. When something is priced in, it stops being a catalyst and becomes a risk. If Powell even slightly leans hawkish, or if he introduces uncertainty rather than certainty, the entire bullish thesis for silver can flip in minutes. Silver is a beta asset. It amplifies macro expectations, but it also amplifies disappointment. Wall Street's caution is not noise. Goldman Sachs calling silver riskier and more volatile than gold is not a casual remark. It's a signal about the institutional perception of this move. Institutions do not treat silver as a safe haven. They treat it as a leveraged proxy. That means when uncertainty spikes or liquidity tightens, silver is the first thing they step away from. Finally, the compression in the gold to silver ratio below 70 is dramatic. But ratios do not collapse because markets reward strength. They collapse because silver overextends relative to gold. Overextensions revert. So the real story here is not the rally itself. It is the instability underneath it. Silver has momentum, but it also has structural weaknesses. And those weaknesses matter more than the headlines. Silver doesn't move in straight lines. When you see a vertical spike, you're staring at a stretched rubber band. Stretching doesn't mean continuation. It means tension. And tension breaks in one of two ways: a sideways release or a snapback. The current rally has pushed silver far beyond its normal volatility envelope. A 4 to 5% session isn't just a candle on the chart. It's a signal that the move has outpaced the market's ability to digest it. When the market can't digest a move, it consolidates. Consolidation is not a maybe, it is a mechanical response. There are 3 triggers you need to watch, and none of them are narrative fluff. They're structural. Liquidity normalization. As London and COMEX liquidity return to their normal states, the artificial compression that amplified the upside disappears. Prices stop behaving like a thin market and start behaving like a real one. That usually means the rally loses its momentum. Macro shock risk. Silver amplifies macro disappointment. If the Fed even hints at a slower pace of cuts, or Powell introduces ambiguity, silver doesn't drift down. It accelerates down because the long side is crowded and late. Positioning unwinding. Retail and momentum accounts pile in after a move is already extended. When the flow reverses, these positions exit first. That creates a cascade. Silver has a history of these air pockets where liquidity disappears on the way down, just like it does on the way up. The important point is this: consolidation is not a sign that the bull move is dead. It is a sign that the market needs to breathe. Markets cannot maintain exponential moves because participants aren't built to handle them. What you're most likely to see is a range formation, not a crash. Silver will oscillate, test the new highs, fail, then drift back toward equilibrium. That equilibrium will sit somewhere between the breakout level and the last major liquidity pocket. If silver holds above the breakout zone, the next leg up remains possible. If it loses it, the rally was a blow-off rather than a trend. Silver has delivered an extraordinary upside move, but extraordinary moves don't automatically translate into sustainable trends. What we saw today was a combination of tight supply, thin liquidity, and a macro narrative that had already been priced in. That mix produces fireworks, not stability. The rally is real. The momentum is real. But the foundation underneath it is not as solid as the headlines suggest. Thin markets exaggerate direction, and when the direction is positive, it looks like a breakout. When it reverses, it looks like a collapse. Silver carries that dual nature because it is a high beta asset. It magnifies whatever macro forces are closest. So the real conclusion is simple. Silver is strong, but it is fragile. Strength without structure is not a trend. It is a spike. And spikes are followed by either consolidation or reversion, rarely by continuation without interruption. If silver holds above the breakout region, the trend remains alive, and the market resumes its climb once the excess tension bleeds off. If it doesn't, the move will retrace sharply, because the same mechanisms that pushed it up will accelerate the downside. Either way, the viewer should understand this. Silver is not a safe haven. It is a volatility engine. You profit from it when the macro winds blow in your direction, and you get punished when they shift. That is the nature of the metal, not a flaw in the story. The deeper opportunity and risk lies in recognizing that volatility itself is the signal, not the headlines, not the records, not the celebratory tone. The structure underneath the price action tells you whether this rally is a foundation or a flare. And that is the message you should carry forward. Gold Rush Reporter. Clear, direct, and grounded in the realities of the market.